Back in October, we talked about the central banks, the need to fight against inflation, and it was going to make recession more likely. And then at the start of this year, we detailed this idea that inflation was likely to moderate across many developed markets. Central banks were going to remain restrictive at these policy rates, but a shallow recession a bit farther in the future. Maybe could you share some color around our analysis today and how the events of the first couple of months have impacted our outlook?
Yeah, so sure. Everything was actually looking quite good over the turn of the year. We saw much more resilient economic data. Inflation was even looking a bit stickier, but of course things turned around very quickly. We saw this banking sector stress that happened in mid-March. So, overall, just taking a step back, given these events, we would just highlight three things that we are really focused on, or three themes about the outlook. The first is that, the banking sector stress has resulted in a higher risk of a deeper recession, maybe sooner. There's various academic studies that suggest when banks perceive a higher cost of capital or a cost of capital is rising, then they actually pull back on their lending growth. And we do think we are seeing a rising cost of capital in the banking sector. So all of that means that we are probably going to see lending growth slow, and slower lending growth is just going to slow the economy. The second thing is that inflation is still elevated. So central banks, they're going to be slower to ease than they have in the past. Going from 4 to 2, again, is going to take more time. And part of the reason for that, is just labor markets are still very strong, or at least they are coming into this period with relative strength. And wage inflation, or the wage level adjustment, has just taken longer to happen. And that's because it's just less flexible than prices. You're going to have wages that are continuing to catch up with the price level adjustment that we've had. And that's just going to mean that wage inflation looks elevated for longer. That means that, probably the Federal Reserve, as a result of tighter credit conditions within banks, maybe they don't need to tighten as much because of this, but, there might not be as fast or as aggressive in terms of easing either, just because they're still having to deal with elevated inflation risks. Then in terms of actually starting that normalization path back to neutral, in the past, we've said, maybe that starts around the end of this year and the brunt of that happens in 2024. And I think that's still reasonable. Just on the third theme, you're going to see that kind of behavior from governments as well. They're not going to preemptively ease, and we're not going to see the type of aggressive response like we did to the pandemic. So the FDIC, the Fed, they still are able to invoke the so-called systemic risk exemption when a bank does fail. They can come in, ex post and say, we're going to guarantee all the deposits. But in terms of a blanket provision ahead of time that would, probably help with confidence, which is so important in these kinds of events, we just don't see that happening. And furthermore, on the regulatory side, that could actually tighten, in the coming quarters as a result of this.
Certainly a lot going on from the macro front. What's your advice for investors today?
Sure. So I think lags with monetary policy, they are working. The tighter financial conditions are becoming more apparent. Recession risks have elevated, but obviously this is a good environment for bonds.